Is Oracle a buy or a sell? Let's get started with the model. This is a large cap company, 522 billion market cap. They're trading at 186 a share and they have 2.8 billion shares outstanding. This company is best known for its Oracle database software. It was founded in 1977, headquartered in Austin, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how much their free cash flow grew from 5 billion to over 8 billion to almost 12 billion. It did come down a little in the trailing 12 months to 11.3 billion, but still over 11 billion is a lot of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That grew from 7 billion to 11 billion, 711. Revenue is the sales for the company, and that grows a little bit each year from 42 billion to 50 billion, up 18%. That's a pretty good growth, but only 6% the next year to 53 billion, up 2% in the trailing 12 months to 54 billion. They do pay a dividend of 0.85%, and they can cover that 2.5 times with their free cash flow. Free cash flow 11 billion, it cost them 4.4 billion to pay the dividends. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 578 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $492 billion. We divide that by 2.8 billion shares. And we get a calculated stock price of 176. They're trading at 186, so they're trading at a 6% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 105 companies in the same industry as Oracle, and if they have a number in red, they're worse than median. If they have a number in blue, they're better. They spend a lot on CapEx, almost 8 billion. The only company bigger is Microsoft, nearly 50 billion. They're really leveraged, debt to equity ratio of 7.8. That means for every dollar equity, nearly $8 of debt. They pay a small dividend, one of 3 companies to pay a dividend in this industry. They generate a ton of free cash flow, much higher than median average. They're second in market cap, far behind Microsoft, far ahead of Adobe. And they look really overvalued according to their price multiples, trading at 47 times earnings and 46 times free cash flow. They generate a lot of revenue, 54 billion, which is more than Microsoft and Adobe as a percent of their market cap. And the way you know that is because they have a lower price sales ratio. They're also lower than Palo Alto Networks, CrowdStrike, and the 3 after that. They're not growing much anymore in terms of revenue. Their 5-year annual revenue growth rate is 1%. They are trading at 186, which is pretty close to their 52-week high, only 5% below that. 84% above their 52-week low. So it looks like it might be a good time to hold off on this stock. You can tell the stock is at a high point when the 50-day moving average is above the 100 and the 200. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $52,000 today, a 423% return, an 18% annual return. To summarize, I have them trading at a 6% premium, ranking 8 out of 10, solid company, great long-term potential, definitely will buy it long-term. Short-term, I might stay away till it comes down a little bit. Really weak ratios, they appear overvalued according to their ratios, 3 out of 10. Even though revenue isn't growing that much, their free cash flow is ballooning, so I gave them financials 8 out of 10. Let's take a look at their most recent 10Q. Here's their income statement. The 3 months ending 8/31/2024, the 3 months ending 8/31/2023. Revenue is up a little bit, 12.5 billion to 13.3 billion. Their biggest revenue is cloud services, 10.5 billion. Last year was 9.5 billion. Cloud license is up a little bit also, 870 million. Hardware is down, it's 655 million. Services, 1.3 billion, also down. Here's a breakdown of their revenue by location. 8.4 billion in the Americas, EMEA 3.2 billion, APAC 1.7 billion, up in every category. Let's look at their expenses. Cloud services 2.6 billion. That's based off of 10.5 billion of revenue, some really good margins. Hardware 160 million of expenses, revenue 655 million. Services 1.1 billion of expenses. That's based on 1.3 billion of revenue. And then you have sales and marketing 2 billion, R&D also 2 billion. So total expenses 9 billion, a little more than last year. Operating income, which is revenue minus operating expenses, that's 4 billion. They spent $840 million of interest on their debt, less than last year. So their net income is $2.9 billion, EPS $1.06, last year 89 cents. They are adding shares, not that many. They added 33 million from last year. It was a little over 2.7 billion last year. Now it's a little under 2.8 billion. Let's look at their balance sheet. Current assets 23 billion, current liabilities 32 billion. So they're a pretty low current ratio. It's below 1. That means they may need to add debt or equity to get through the next 12 months. Their total assets 144 billion. The biggest asset is goodwill, 62 billion. Their total liabilities 100 billion. Their biggest liability is notes payable and other debt, 75 billion. Assets minus liabilities equals equity, 11 billion of equity. They raised 33 billion from selling their business, selling stock. They lost 21 billion from running their business. The reason they have an accumulated deficit is because they buy back a lot of stock. If they didn't buy back so much stock, they would have positive retained earnings. Let's look at a statement of cash flows. The first section is operating cash flow. That's 7.4 billion. Last year, 7 billion. So they have a lot of cash flow. Their net income is only 3 billion, but they receive a lot of deferred revenue. This is when they receive a payment for product or service before it's delivered. They spent 2.3 billion in CapEx. These are investments in property, plant, and equipment. In their financing section, they had a cash outflow of 4.6 billion. They paid 1.1 billion of dividends. They added 5.6 billion of debt. They paid down 7.6 billion of debt. Let's look at a stock on Simply Wall Street. Its last price, 190, 530 billion market cap, up 5% in the past week, up 65% in the past year. Here's where the stock has been trading since 1990. And these numbers are stock split adjusted. It looks like it IPO'd at 56 cents. Then it hit 40 in 2000. If you bought it then and you waited 20 years, you would have been flat on the stock. It was trading at 43 in March 2020. Hopefully that didn't happen to you and you held on, because since 2020 it's done really well. It's more than tripled since then, from 50 to almost 200, almost quadrupled. Simply Wall Street's valuation is 274. They say the stock is 31% undervalued. 30 analysts priced this stock at 187. They say it's overvalued. Here's their revenue since 2014. It was 38 billion. And it didn't really move too much over the next 7 or 8 years. It was still under 40 billion by 2021. Only in the past 2 or 3 years it started moving up. Now it's 54 billion. From 38 billion to 54 billion. That's not much of a growth over 10, 11 years. And this company has a lot of debt. It was 24 billion in 2014. Now it's 85 billion. And when you look at their equity, it's much lower than their debt. At one point it was really close. Then their equity was negative in 2021. Now it's real low, 11 billion. A really poor debt to equity ratio. And they only have 11 billion of cash on their balance sheet, a lot lower than their debt. Here's their dividend yield since 2015. It was 1.1%. It did get up to 2% in 2020. Now it's back under 1%. The forecast is still under 1% by 2027. The CEO's salary is a little under 1 million since 2018. Total compensation, 6.5 million. Tenure as CEO, 5.3 years. 45% of the company is owned by institutions, 42% by insiders, and 14% by the general public. The founder, Larry Ellison, is the biggest shareholder at 41%. He's worth $219 billion. The next biggest is Vanguard at 5.6%, BlackRock at 5%, JP Morgan, Capital Research, Loomis, Janus, First Eagle, BNY Asset, Eaton Vance, Norgus, Managed Account Advisors, and their employee count has gone up from 122,000 to 159,000. It was 164,000 last year, but they did cut some jobs. And the ticker trades on the New York Stock Exchange, Mexican Bolsa, Lima Bolsa, Deutsche Börse, London Stock Exchange, Zitra, Santiago, Bern, EuroTLX, Swiss, Wiener Börse, BATS Europe, Buenos Aires, and the Sao Paulo Bolsa. So if you want to learn how to build a discounted cash flow model, watch this video in the top right corner. I even send you a free version.